Today's 1-hour session will cover an overview of the accounting standards updates, ASUs, released for year-end of 2022, along with 2023 that may impact your business. Now, we have an impressive group of attendees on this session today, and that number continues to climb. We will be offering 1 hour of CPE for today's session. Here's some items to note before we get started. To receive CPE credit, you must answer at least 3 polling questions and attend for the full 50 minutes. Those CPE certificates will be issued via email within 10 days. If you have not received yours after 10 days, please email cbhlearning@cbh.com. A recorded version of this webinar will also be available in about a week. It'll be sent via email and posted to our website. Now, if you have any questions during the webinar, type those into the Q&A window located down in your control panel. And just note, a short survey will also be posted at the conclusion of the webinar. We value your feedback and ask that you take part. Now, I'd like to introduce Michael Hoos, Director with Cherry Bekaert's Professional Practices. Thank you so much for being on here today. Please, Michael, take it away.
Thank you very much. And thank you everyone for attending. Today, we're going to learn about the new standards that are required to be adopted for those calendar year ends. Then we're going to identify some new standards that are not yet effective, but that you should consider early adopting. And then I'm just going to make you aware of some new standards that are not yet effective. You probably shouldn't early adopt, but that could have a significant impact on the future. And so with that, let's just go ahead and jump right in. We're going to kind of separate this course into 2 parts. Most of it, 80% of it's going to be accounting, ASUs. We are going to talk briefly about a few independent standards. I'm not going to focus on that simply because I'm assuming that everyone's already had their ethics and independence training for the past year. I do want to also say one thing, webinars on ASU updates can sometimes be difficult because, well, not every ASU is going to apply to everyone. So not going to go into super great depth of every single ASU, and there are going to be some ASUs that maybe just aren't applicable to you, but hopefully there'll be a few that catch your attention. And with that, let's go ahead and start our first polling question. And that is, has your organization already assessed the impacts of the latest ASUs? The options are yes, we have everything under control. Yes, we've started but need a little help, or no, we haven't really started, but we'll get to it in a couple weeks. And the last 2 are we are not sure what to do, or we're just unsure if we've started assessing the impacts of the latest ASU. All right.
All right, and we're going to leave this poll open for about 10 more seconds. We did have a question if the slides were going to be available after this. We will share a copy of the recording with you guys so you can reference the slides, but we do not have a downloadable version of the slides right now. So thank you guys for being here. If you do have any questions, again, put those in the Q&A window and we will get to those as soon as possible. Okay, I'm going to go ahead and end the poll, share those results.
All right. So it looks like most folks had started but needed a little bit of help, or plan to do so in the next few weeks. So hopefully this course will kind of help you do that, or at least kind of focus in on some of the ASUs that would be more impactful to your organization. So we're going to start with ASUs that are effective for public businesses. I will say that little asterisk next to the word effective, we're not going to cover like minor changes that aren't expected to change current practice, typically called codification improvements, nor does this list include ASUs that are just ASUs that defer a date of something. And lastly, it's not going to include ASUs that are that compound on top of each other. Like, there might be the new lease standard, but then there's many ASUs after that adjust it. So we're just going to condense them into one ASU for these lists. And so with that, for public business entities, the ones that are effective for this calendar year end 12/31/22 are ASU 2020-06, which is accounting for convertible instruments and contracts in an entity's own equity. That one could be pretty impactful. I've seen it used, and I also saw it early adopted in Q1 for a lot of entities that we provide services for. The next one is ASU 2020-07, which is the presentation and disclosures by not-for-profit entities for contributed non-financial assets. The next one after that is ASU 2021-01, which really deals with the reference rate reform. And then moving on to the list on the right, we're going to go into ASU 2021-04, which deals with issuers accounting for modifications to freestanding equity instruments like warrants and options. Moving down to ASU 2021-05, which deals with lessors. That's going to be one that I'm not going to be talking a lot about the new lease standard when we get into private entities, because I'm sure that you're probably have received many courses on that and are tired of hearing about it. But that might be one ASU that is to keep in mind if you are a private entity that we are going to be covering. And that really just deals with certain leases from a lessor's perspective that are predominantly variable lease payments. And then the last one is ASU 2021-10, which is dealing with disclosures about business entities that receive government assistance. And so with that, let's go ahead and jump into the details of the first one, which is debt with conversion and other options, right? And so this one, what it basically does is it eliminates the cash conversion and beneficial conversion models, okay? And so from a balance sheet impact, if you've ever dealt with beneficial conversion features, those are when debt can be converted into equity and the rate that it can be converted into equity is below market. And so you have a beneficial conversion, as they call it. And typically that would have been bifurcated away from the debt instrument and recorded. And so that usually was recorded as a debt discount. So by this removing of that, you're going to end up having a balance sheet impact where you're going to increase your debt and then you're going to lower your equity a little bit relative to what you would have before. And that debt discount would have been amortized into interest expense. And so you have lower interest expense because of that. And so those are, pretty much the biggest impact, but there's a couple hidden nuggets in there, if you will, that we're going to talk about. And that's what I, kind of consider my job, is telling you the big headlines so you can understand it, but also and identifying those like nuggets in there that can really, help add value that many people might be overlooking. This ASU requires the if converted method if you have convertible instruments when you're trying to compute your EPS calculation. It requires the effect of potential share settlement to be included in diluted EPS. And it has a few other EPS clarifications. What I think the nugget for this one is several fold. One is additional disclosures. So it's getting rid of the BCF, and many people didn't like the BCF because, well, you had to have a valuation of it. You had to compute that value in order to bifurcate that instrument, the BCF portion of it. And so now they're going to say, okay, you get rid of that. And many people thought, well, that's great. I'm not going to have any kind of valuation of that BCF or that instrument because of it. That's where I think the little nugget and the often overlooked part of this standard comes into play, because you still have to disclose the conditions or events that could cause conversion and what party controls those conversion rights. And the very last underlined bullet point, you have to now disclose the fair value of individual convertible instruments rather than aggregate them all together. And so in one way, the FASB is saying, hey, you don't have to value that BCF when you first enter into the debt so that you can properly bifurcate it from the host instrument. But they also take away with one hand or give with one hand and take away from the other, because they say, well, now you have to have a fair value disclosure. So you're still going to end up having that cumbersome fair value calculation that needs to be done. And so, there's several standards that I've seen that are like that, where it appears to be a relief, and it is to some degree, but at the end of the day, it doesn't change all that much from a, operational perspective. You're still gonna have to get that valuation. Some of the other things that ASU 2020-06 does is it removes the following conditions from settlement guidance. So if you are familiar with instruments that could be settled in your entity's own stock, you know that there's a guidance within 81540 that basically says that you have to meet certain conditions in order to classify something as equity if that instrument can be settled in the entity's own stock. And 3 of those are no longer going to be applicable after this ASU, and that is you had to be able to settle that instrument in unregistered shares, with the thought being that you don't have control over registration, and so therefore you don't have control over conversion of an instrument, and so therefore you might end up having to, even if it's not in the instrument's agreement, pay cash for that. And so it used to be that you had to record those as a liability if that instrument required settlement in registered shares. That's no longer applicable. Along the same lines, it used to be that if you that instrument required some sort of form of collateral, that you couldn't record that in equity, and so you'd have to record it as a liability. That's gone away. And then there was a similar a clause in the guidance that said, well, if the shareholder rights for the counterparty to this agreement that could be settled in entity shares, that if those shareholder rights were above and beyond the shareholder rights of the underlying shares that it would be converted into, that you would end up having to record that as a liability as well, and that's gone away. But the second big nugget in this ASU, I will say, is it clarifies that regardless of whether an instrument meets the definition of a derivative, it should be remeasured at fair value each reporting period if it fails either of the tests in 81540. And let me give you a little bit of context here. And they actually talk about this in the basis for conclusion paragraph of this ASU. And that is that, and I've seen this in practice as well, many private entities said, hey, my shares are not readily convertible to cash. I can't go to the market and easily convert them into cash. So they do not meet the definition of a derivative. So if they do not meet the definition of a derivative, I'm just going to kind of stop there and not have to assess under 81540 whether that is, whether it would have been considered indexed to the entity's own stock, and if so, whether it met the settlement criteria, some of which we just went over. And so that's been clarified that no, even if you don't meet the definition of a derivative, you still have to apply the derivative accounting subtopic 81540. And that is, it has to be considered indexed to the entity's own stock, and it has to meet the settlement criteria that still exists after this ASU. And so it's possible now that instruments that previously were, did not meet the definition of derivative, and so therefore were not accounted for as a liability. And the key here is that when you account for it as a liability, you have to market the fair value every reporting period, which makes it a costly valuation and that kind of thing. What this says is, okay, yeah, even if it doesn't meet the definition of derivative, you still have to meet these subtopic conditions in 81540 in order to be considered, to get the accounting treatment that you want, which is to not have to record it as a liability and not have to fair value it. And so that could be a change for a lot of folks. And they mentioned that in the basis for conclusion paragraph, that we expect some private companies to previously, they had recorded an instrument and not considered it something that needed to be a liability and mark to market, and now they will. And it provides some other clarifications that we won't go into details on, again, since this is supposed to be a higher level review. This standard, it is required for public business entities that are not small reporting companies. It was required for annual periods beginning in fiscal years after December 15th, 2021. And then for interim periods of that same quarter. And yes, early adoption was allowed for other entities. And as you can kind of see too in that previous slide, for private businesses, that's no longer, it's not going to be applicable for like another couple of years, though I anticipate everyone's going to early adopt that. And we'll talk about that a little bit when we get into the early adoption slides. The next ASU is ASU 2020-07, and that one deals with presentation and disclosure by not-for-profit entities for contributed non-financial assets. All right. And so this is a pretty simple one, I guess. It says that you have to disclose the disaggregated contributed non-financial assets by category, right? And so in addition, it says you have to disclose for each category the qualitative information about whether the contributed financial assets were either monetized or if they were utilized. If the not-for-profits policy, if there is any, about monetizing rather than utilizing contributed non-financial assets, you need to disclose a description of any donor-imposed restrictions associated with the contributed non-financial assets, a description of the evaluation techniques and the inputs that you use to arrive at the fair value, just like you would in accordance with any, topic 820 fair value measurements. And the principal market or the most advantageous market that you use to arrive at the fair value measurements, right? This is effective for annual periods beginning after June 15th, 2021, and interim periods within that. Early adoption is permitted, so for the private entities out there, and the amendments should be applied retrospectively. The next ASU is ASU 2021-01, and the subsequent ASUs after that that tweaked it, including one that was at the very end of 2022. And this one deals with reference rate reform. So if you're not familiar with this, back in 2017, there was a little bit before that, there was a LIBOR scandal, you might remember, okay? And there was some manipulation of the LIBOR rates. And so in July of 2017, the UK's Financial Conduct Authority, the FCA, announced that it would no longer persuade or compel banks to submit LIBOR, okay? Now, the thing is many instruments for accounting purposes contain LIBOR language in there. And so that could have an impact, because generally when you had an instrument that has LIBOR and you modify any financial instrument, whether it's a swap or even, a bank loan, you end up having certain accounting that you have to go through. You have to determine, well, has it been modified? Is it considered extinguished? Or does the instrument no longer qualify for hedge accounting? That kind of thing. So a lot of questions arose. And so non-USD LIBOR no longer existed as of December 31st, 2021, and USD LIBOR will not exist as of June 30th of this year, okay? And so the Federal Reserve said, hey, we'd like people to replace LIBOR with the Secured Overnight Financing Rate, or SOFR. And so it's incumbent on entities to identify all agreements that contain LIBOR, and some of them might have what's called fallback language, which it says what happens if that, what the replacement rate will be, and what the trigger for that replacement would be. And some might not contain that. And so it's really incumbent on the entity to go and look at this and then possibly negotiate with the bank if they need to. And so that last bullet point here, the question arose, well, how do I modify? Do I count for this as a modification? Do I dedesignate the hedge? Sort of things like that. And what this ASU basically does is it says it's optional, and you cannot apply to modifications that occur after, and this is the part that was amended in late December, to modifications that occur after the year December 31st, 2024, right? But what it says is that as long as you apply this consistently to eligible contracts, you can generally, that third to the last bullet point, you can, as a result of this ASUs, you can basically consider it a moot point, and that you don't really have to account for the change as long as all you're really changing is that LIBOR to a different rate, right? So it doesn't require remeasurement or reassessment, anything like that. And so that's basically what this does. And the real thing I really want to teach you guys is, if you guys haven't already looked at what agreements do we have that contain LIBOR, it could be debt, leases, a whole host of things. This is, the time that you really need to be doing that. And again, you don't want to just rely on the bank to, if there's no fallback language, decide what they want the rate to replace is. You would want a negotiation if you can, to make sure that you guys are made whole. So this next one is ASU 2021-04, and this one deals with accounting for certain modifications or exchanges of freestanding equity. And so I've seen this a lot in practice where there'll be like an outstanding warrant or option out there, and there'll be a modification, generally like in the annual shareholder meeting. They might adjust, extend the terms of certain warrants that were going to expire, that kind of thing. And there's been other instances where there's changes to these freestanding financial instruments that, well, how do I account for that? There's a lot of guidance in ASC 718 for how do I account for a modification of some sort of a share-based payment to my employees, but there's really not a whole lot of guidance until this ASU on, well, what do I do if this modification is, not for a option that an employee holds, right? And so this applies to all modifications or exchanges of equity classified written call options or warrants, and that would remain equity classified after the modification. And so the concept is simple. It's that you should account for the transaction no differently than what you would if the issuer had paid cash instead of modifying the warrants, right? And so that incremental value of the modification or exchange, so the value difference between before and after the modification, that should be attributed to any proposed equity offering or debt offering, and it should be accounted for the same way as you would if you had paid cash. So for those of you who are familiar with equity offerings, generally what ends up happening is that if you also pay, say, a broker or some sort of a third party, that you would end up reducing your proceeds. So if you received $1 million in equity raise, but you had to pay $100,000 in fees to the underwriter, well, then you would just recognize $900,000 as being what had received in your equity offering. And so that's the same thing you would do if you had a modification to a warrant that is in connection with such an equity offering. Along those same lines, if you had a modification that was connected with the issuance of new debt, then it really depends, just like you would with debt issuance cost, on who the holder is of that warrant. If the warrant holder is the lender, then the incremental value would be treated as a debt discount. If the warrant holder was not a lender, it'd be treated as debt issuance cost, and both of those would be amortized into interest expense. Now, if it's not related to the modification, and instead it's related to debt extinguishment, okay, then you have to make a decision, okay? So if it's debt extinguishment, and the holder is the lender, then you would expense essentially that incremental value, right? And then if the holder, though, is the lender, you would end up capitalizing it. Now, if the modification does not qualify as debt extinguishment, but instead debt modification, then again, it would treat it just like you would if you paid fees in accordance with the debt modification. And that depends upon whether the holder is the lender or some other party. If the holder was a lender in a debt modification and you had those modifications to the equity instruments, you'd capitalize it. Juxtapose that to if the holder was a lender, then you would expense it. So the key concept here is that you need to treat things as though it were cash. And so the rules about how you treat payments to the lender or third party, whether it's a debt extinguishment or modification, those things are going to hold true just like you would if you paid cash. Now, you have to use judgment that ASU talks about if that modification is related to the transfer of goods or services, right? And so you would have to account for it like you paid additional money to that service provider. But if the modification is not related to anything, so it wasn't like we modified an equity instrument when we transferred goods or services, or to the person that did that, or we're doing an equity raise or issuance of new debt, or the modification or extinguishment of existing debt, if it has nothing to do with any of those, and I've seen this happen in practice where there's no real reason that the company was obligated to make a change to the equity instrument, they just kind of did it out of the kindness of their heart, if you will. And I've seen this a lot, especially with large shareholders and stuff like that. You treat it as a deemed dividend because the idea is that you're giving value from one set of equity holders to another, in that opinion. And so This is going to be effective for, annual periods beginning after December 15th, 2021. So that's why it's effective for this coming 12/31/2022 busy season. And early adoption is permitted for those private companies out there. I would, if you know a standard is going to eventually become effective for you, you would make sure that you would want to early adopt that, though this one in particular is effective for all entities as of that period. The next one is ASU 2021-01. And this one is one of the few, lease ones I'm going to talk about because, again, most of you are probably, tired of hearing about leases. And this is one that for public companies, they had to adopt the lease standard already. And so this one really is, impactful for them if they have such leases. And what this is it only relates to leases from a lessor's perspective that are predominantly variable payments. So if you know from 842 that you have to have a, when you compute the ROU asset or the lease liability, you use the present value of lease payments, and lease payments is defined as those that are fixed and those that are variable, but that are based upon an index, right? So if it's variable and not based upon an index, then it's not considered part of the lease payments for that present value of lease payment calculation. Well, that created a weird situation here. So if you're a lessor under 842 for a sales type or direct financing lease, you would require to make the following entry, right? Which is that you de-recognize the asset, that's the bottom credit there, and you would recognize a net investment and lease. But that net investment and lease was the present value of all lease payments, which again, did not include your variable lease payments that were not based upon an index. So that created a mix match between the debit and the credit. And so that's where a day one loss would have been recorded, right? And so what this ASU basically does is it says that lessors should classify a lease that's predominantly variable lease payments as operating if accounting for it the way you should normally account for them would have caused a day one loss, right? And so there's really going to be no balance sheet impact if you account for it as an operating lease. You would just recognize income as it becomes due and continue to depreciate the asset. So that's mostly going to affect electric companies and things like that. Those a lot of electric companies would have a lease, and the lease payment would be based upon the megawatts that were generated, especially like for clean energy and that kind of thing. This one was effective for public business entities for fiscal years beginning after December 15th, 2021. And then same thing with all other entities. And so this is going to be impactful for both public and for private. The transition method, it really depends on what your transition method for 842 is what's going to be impactful there. The next one is ASU 2021-10, and this one deals with disclosures by business entities about government assistance. So this, the PPP loans, the earned employee retention credit, those kind of things. How would you disclose those? And so there was a little bit of question about this, and it's typical for the FASB. Sometimes the standard comes, after many of the filings that originally had to deal with this. And so there was diversity in practice. And so this really just kind of cleans it up and says, hey, this is what you should disclose. And it says that you're required to disclose the following about transactions with governments that are accounted for by applying grant or contribution model by analogy. If you recall, when we were dealing with PPP loans, a lot of folks, there was no specific guidance under US GAAP, and so people analogize to either grant guidance or contribution accounting. And it's common sense here, basically, which is that you need to disclose the information about the nature of the transactions and the accounting policy used for the transactions, the line items and amounts in the balance sheet and income statement that are affected by those transactions, and any significant terms or conditions of the transactions, including commitments and contingencies. This one was effective for all entities for financial periods beginning after December 15th, 2021. So 12/31/2022, busy season. Early application was permitted. and it could be applied, either prospectively or retrospectively. And so those are the main ASUs that are going to be impactful for public businesses that are ending 12/31/2022. A number of those also are going to be impactful for private entities, as I've just mentioned. And so that leads us into the next set, which is really those that are applicable to private entities. And I've got some of them here in red here, because these are the ones we're not going to talk about because, well, we just talked about them. Or, for example, in the first two, you've either adopted them or have heard about them, ad nauseum. And so the first one is ASU 2016-02, the big one, leases. Again, the ASU that related to variable lease payments, the only one I'm going to talk about related to leases, because I'm assuming everyone's well aware of that and has been working on it. The next one here is an old one, 2017-04, and it's just now becoming required to be adopted. But I'm not going to talk about it because everyone's already adopted it. And that is, what it did is, when you had a goodwill impairment test, it used to be that you had what they call step 0, the qualitative analysis, step 1, and then step 2. And step 2 has been removed. And most folks who do impairment analysis, in fact, I haven't seen a step 2 performed in years now. They early adopted it because step 2 was cumbersome and costly and that kind of thing. So we're not going to talk about that ASU. We're not going to talk about these other 3 ASUs on the right-hand side of your screen because, well, we just talked about them. So we're going to be talking about these 3 ones here that are in gray here. All right. And so the first one here is simplifying the accounting for income taxes. Now, I'm a very straight shooter kind of guy. I am not an expert in income tax. I'm an expert in a lot of things, but income taxes are not that. So I'm going to caveat that, you really should be talking with a tax professional if you have any of these. And hopefully, if you're lucky, you're not the one having to prepare the tax provision and that kind of thing. But what this does is it simplifies accounting for a number of different tax situations. A hybrid tax regime, so that's when you have a tax regime that's partially based on income and partially based upon, maybe capital or things like that, like a franchise tax, okay? And so some, jurisdictions and taxes are hybrid, and you would pay the larger of the two, whether it was the larger of the income-based tax or the equity-based tax. And so this clarifies some things around that. Same thing to step up in the basis of tax of goodwill for tax purposes. That's, you buy, everyone's familiar with goodwill and a business combination, and then you might step it up because, oh, well, we had some other transaction, like a lot of times, like if you pay governments, that kind of thing, there'll be a step up in your goodwill basis. The ones I'm talking about are the ones in red because I feel like those might be more impactful. And that is like separate financial statements of a non-taxable legal entity in a consolidated group, right? And so ASC 70 and 7040 requires that the consolidated amount of current and deferred tax for a group that files a consolidated tax return, that if you're a member of that group, that consolidated tax return should be allocated to the group members. But that kind of raised a lot of questions. Well, should I allocate it to a group that's that's part of a consolidated group, that one particular entity that is not even non-taxable, right? Like something that's a complete flow through with a single member of it, right? And so that created a little bit of consternation and cost and complexity. And so as a result, FASB amended the 740 with this ASU to clarify that legal entities that are non-taxable and not subject to tax are not required to be allocated that tax from the consolidated group in their individual financial statements. So you'd have these individual financial statements that are separate from the consolidated group, that they would have to allocate some sort of consolidated tax amount to there. And that just didn't make sense to a lot of folks. And so they've simplified that. The other one I want to talk about here, again, this slide, I really want you to take away from this is, hey, I've got one of these conditions. Let me go talk with my tax accountant about this. So they know there's going to be a change in how the accounting for it under 740 is. So more so know there's a rule than what the rule is. But the one rule that I will talk about lastly here is the interim period accounting for enacted changes in tax law. So under US GAAP, an entity should determine the tax effect of income from continuing operations if there's like a change in in tax law, you would essentially have to apply that to an interim period, and it was unclear exactly how you would do it, because prior to this guidance, 740 would require that the tax effect of a change in tax law or rates be recognized in the period that includes the enactment date. But then there was also part of 740 that said that you should, that the effect of that change in tax law or rates should be recorded after the effective date, but no earlier than the enactment date. So there's a little confusion about when there's a tax law change, when do I represent that in the books, right? And so there's diversity in practice. And so what FASB did is they issued this ASU, and it requires the effects of an enacted change in tax law to be reflected in the computation of your annual effective tax rate, or AETR. All right. And that's required to be done in the first interim period that includes the enactment date, right? So the change gets essentially indirectly included in the current quarter that you are issuing, because it gets included in your annual effective tax rate. So the annual effective tax rate is something that a company does to develop its best estimate of what the annual effective tax rate is going to be, and then they compute what they think the year-to-date taxes, and then they plug and they adjust interest expense to make that happen, or tax expense to make that happen. So that's how it gets applied in this particular situation. Again, from this, I want you to really know hey, I have one of these things I need to talk to a financial expert in taxes about, more so than know the rule itself. This, of course, is effective. It was effective for public business entities for fiscal year ending 12/31/21, and now it is effective for private entities for this coming 12/31/2022 busy season. And that leads us to our second polling, which is, does your entity have an investment account under the cost method? So that is, when you are not able to readily determine the fair value of something, an investment, do you have do you record it at cost, basically? And so that's kind of the question: is yes, no, don't know, what's readily determinable fair value? I think we all, if you're familiar with this, don't know what readily determinable fair value is. So give people a few minutes to answer that question.
All right, and while we wait for those poll responses to come in, we did have a question about, could you consider a beneficial interest in perpetual trusts as being interpreted as a financial asset?
A beneficial interest in a
trust.
I will have to get back on that one. I do not know. I do not know off the top of my head if that what the answer is to that one.
Okay, sounds good. And then I do think there's a couple people who are having some errors getting their poll question answered. So if that happens to be you, go ahead and put your response within the chat, and we'll make sure that that gets collected. We do have 5 poll questions total, so just for CPE purposes, we need to answer 3 of the 5. So you should be good, but feel free to answer in the chat. Okay, we're going to go ahead and end the poll now.
Okay.
Share our results.
All right. So most folks said no, and I'm actually surprised to see about 20% said yes. So we'll talk a little bit about that. All right. So this next ASU is 2020-01, and it says that it clarifies the interaction between 321 and 323 and 815. But really, the way I look at this ASU is that we had an ASU in 2016-01 that allowed equity investments that were not accounted for under the equity method, right? The equity method, when you have significant influence, generally 20% or more ownership, or that were not accounted for under some specialized industry accounting, or did not qualify for the NAV practical expedient, and that were accounted for under the cost method. So they did not have a readily determinable fair value. And what that ASU did is it said, hey, you can, not record things at fair value. You can keep it at cost, but you have to adjust for impairments and observable price changes, right? So that meant that you would have to look and see if there were any, hand length transactions between the entity that you have an investment in and some other party out there that would indicate that, hey, there's an impairment or a price change, right? Like I bought something at $1 per share, and now this entity that I invested in just sold for 10 cents per share. Okay, probably have an impairment. There's an observable price change, that kind of thing. And so a question arose, which is, okay, when you are changing your basis of accounting. So in other words, you get additional ownership, so you become equity method, or you had equity method and you're going down the cost method, right? So when you had these step ups, well, is that a time in which you need to assess whether there is an observable price change? And what this does is it says, yes, when you have a step up in your basis, your ownership from cost method to equity or from equity method to cost method, you need to assess at that point in time if there are any other observable price changes. It also clarifies that when you're determining if an instrument is within the scope of 815, that you should not consider whether upon settlement of that instrument that it would be required to account for under the equity method. So some folks said, yeah, technically it's not qualified as an equity method investment right now, but when I do settle it, it will be. So therefore, do I not apply 815, even though it might meet the definition within the scope of 815 now? Because when I settle it, it's not going to. And they said, no, you need to consider what the instrument should be classified as now. And when you do your equity method, then that's when you would account for it under the equity method. Again, this is, obviously effective for, 12/31/2022 entities for that are private, and it was effective in 12/31/21 for public entities. You would apply this either full retrospective, modified retrospective, so cumulative change in equity, or a fair value option. The next one is ASU 2021-07, and this one deals with determining the current price of an underlying share. This one I think is probably the most impactful one, right? So this is where I issue, let's say I'm a private company and I issue stock-based comp, or I issue some instrument that I would use a Black-Scholes model to value, right? And so it's optional and it's only available to private companies. And the biggest hurdle was, oh, shoot, I just issued a share-based comp. Now I got to go get an expensive valuation because, well, unlike public companies that can go on Yahoo Finance and figure out what the stock price is, there's no way for me to determine what the stock price is for a private company usually, because they're not freely traded, right? And so you'd go and you get this costly valuation, and it just became cumbersome. And so people kind of pushed back on that. And so the FASB tried to help you out, but as you'll see, they really didn't help you out. So the FASB said in the second bullet point here, if elected, this ASU, you would require to use a reasonable application of a reasonable valuation method to determine the fair value of the shares, the underlying share. That's the major input in your Black-Scholes. Well, of course, when you hear reasonable application of a reasonable valuation method, you're like, what the heck is that? Well, it basically says that, hey, if you did the valuation in accordance with your 409A, so for those of you who might not be familiar, in order to receive special tax treatment, you had to qualify under a tax code 409A. And so people would get a valuation for 409A purposes. So that actually had direct benefit to them because they'd have a special tax treatment. If the valuation meets those standards, then we, for book purposes, will accept that, right? But they also say that, and this is the two underlying parts here, the real important parts, which is that they would still expect that an independent appraisal will most often be used to get that 409A valuation, right? So on one hand, they're saying, well, you don't have to get the valuation, but you really probably still need to, right? And so unless you have a valuation expert, or a financial expert at your company that can meet the 409A criteria, which is pretty stringent, you're probably still going to have to get a valuation. The other big thing here is that I've seen this in practice where there'll be a valuation done and then maybe another set of share-based comp is issued about, a few months or maybe, longer than a year later. And a lot of times, people would not follow the gold standard and they'd kind of use that older valuation and say, hey, nothing's really changed. We don't think that the value of the underlying share is materially different than it was, say, 18 months ago. Well, what this says is that you're explicitly prohibited from using a valuation that was done a year prior to the issuance of this latest stock-based comp. And so that could be a little bit of change for folks. And it also says, which has always been the case, if you are using a valuation that's done not at the date of the grant of these new stock options, you would have to at least use a justification for it. We don't think anything's changed to the underlying share price since our previous old valuation and this new grant date for the stock-based comp, right? And so it says if it's within a year, you still have to document that, but if it's out of a year, you're just out of luck, you have to get a new valuation. Again, this is effective for fiscal years beginning after December 15, 2021, and early adoption was permitted. All right, question number 3. And that is, private entities are no longer expected to obtain an independent appraisal to determine the fair value of their shares, and using a 409A valuation greater than 1 year is acceptable. So we'll see how many folks are truly paying attention here. Hopefully you can get this right. Give people a few minutes here to answer this. So is it true that private entities are no longer expected to obtain an independent appraisal? Or is it false? Is it true or false that using a 409A valuation greater than a year is acceptable?
Okay, and we have almost 90% of you who have answered right now. We're going to give you about 10 more seconds to get that response in.
Okay.
All right, I'm going to go ahead and end the poll.
Okay.
And here's our results.
False, false. All right. Or true, false. Okay. So just to kind of recap here a little bit, if they still expect most private entities to get an independent appraisal, a third-party valuation, even though they say that it's not technically required anymore. They basically say that unless you have a specific situation where you would have met the 409A criteria with using an internal valuation folk, that they would still expect you to get a valuation done. So in other words, if you want to not get a valuation, you're probably going to have more of an uphill battle, but it's now possible. So I would say that's more false. And then, of course, using a 409A valuation greater than a year old is not acceptable. That's explicitly prohibited. So it should be false, false. All right. So those are all the ASUs that for public companies that you're required and private companies you're required to adopt. Here's some things that you should consider early adopting. And I put the little asterisk there is for private companies. Most of those folks on the course here are from private entities, and most of the client base that we have is private. So instead of having 2 sets of these, I just use the private entity. This is what you should consider early adopting. Some of these would also be something that a public entity should consider as well if it's not already required. And so the first one here, we've already talked about 2020-06. That is, got rid of the beneficial conversion feature. Many people wanted to early adopt that. And so that was something for that if you were a public company, you would have had to adopt in the first quarter. That's something that I'm not going to talk about because we've already And so the two that I'm going to talk about that public companies are not required to adopt that you really should consider early adopting are the 2021-08 and 2022-03. So 2021-08, all right, this one deals with when you have a business combination, right? So when you have a business combination, right, you have to measure everything at fair value. Well, for those of you who've gone through a business combination, you know that, well, measuring everything at fair value, one, it's costly and cumbersome, but two, there's this situation that arises where you had deferred revenue from the acquiree that the way you would fair value the liability is you would have to determine the cost of completing that good or service. And so there would be a disconnect between the deferred revenue that the acquiree had and the cost that it would actually take to settle this, especially in a lot of entities that have high profit margins and that kind of thing. And so you would end up having what's called, lost revenue, which is that you would market the fair value. And so that deferred revenue in the acquiree's books, not all of it got to be recognized in future periods on a GAAP basis, right? And so what this does is it says, no, you're required to recognize and measure contract assets and contract liabilities like deferred revenue, things that are related to 606 in a business combination in accordance with 606. You don't have to mark them to fair value in accordance with 805. So it's kind of an exception to the rule that 805 says that you have to mark the fair value, right? And generally, this is going to result in acquirer recognizing and measuring the acquired contract assets and liabilities the same as they were on the acquiree's financial statements. Now, the one caveat here is, well, if the acquiree got it wrong and they accounted for it incorrectly, you can't say, well, that's the way they're accounting for it. I don't have to remeasure it. And then the other thing, too, is if the acquiree used certain practical expedients and policy elections that are different than what the acquirer uses, you would have to adjust it as well. But the main focus here, and this is a good standard, that basically now I don't have to have lost revenue and market at fair value. I get to roll it forward, assuming, again, that they acquiree accounted for it correctly and that there aren't any major policy election differences. Now, this does not apply to other types of assets and liabilities like refund liabilities or customer-related intangibles. This is, not a get out of jail free from having to do an 805 valuation. It's just really specific to your revenue. Now, this is effective for public business entities beginning after December 15, 2022, and for the next row down for private entities the following year. But this is something I anticipate most folks, if they haven't already early adopted, are going to want to early adopt this, just because, again, you don't want to, waste money getting something valued that you don't have to get fair valued, and you don't want to lose revenue, so to speak, obviously. The next one here is 2022-03. This one deals with a measurement of equity securities that have some sort of contractual restriction, right? Like a lockup agreement. And what it basically says is that if you have a contractual restriction on the sale of an equity security, that's not part of the unit of account, right? So when you fair value that equity instrument and the holder have a contractual restriction, that doesn't come into play in the fair value. So this all relates to the second bullet point here, the DLOM, right? The discount for lack of marketability, right? And so the real thing here is the underlying part, which is that it really hinges on whether that restriction is part of the actual instrument or is it related to a restriction that the holder has, all right? If it's actually part of the instrument, right, then, for example, shares issued through a private placement or unregistered shares, Rule 144 shares, so to speak, then that's part of the actual, instrument, right? Not necessarily the holder. And so that would be part of your DLOM. But if you had some sort of lockup agreement that the holder has that's unique to you, that would not be something that you would compute in the fair value. And again, this is effective for public business entities for really 12/31/2024 year ends, and then for public business entities a year after. But again, I think this is something that people are going to probably want to early adopt. And then this is ASUs that are effective in the future, but you should consider now. All right, the big one is CECL, which I'm going to have a slide on in a second. And the other one is there's a proposed standard out there, has not yet been adopted. I typically don't like to talk about proposed standards because really you just want to know what's really happening. But this one is pretty profound, the second bullet one, which is it basically says that there's a lot of questions that are arising over leases with related parties. Maybe they're not written. Maybe they're written, but they're expired 10 years ago and they're just going month to month. Or maybe they're written, but the written terms don't seem to be on market terms. With this proposed standard, which I anticipate will be ultimately adopted, so keep on the lookout for this. It basically says if I have a related party lease and I'm a private entity, I have a related party lease, and the third criteria is that related party is under common control with my entity, I just look at the written terms. Now, if there's no written terms, you'd have to consider what is legally enforceable in that thing. But if you had written terms, you don't try to find implied related party, agreements or anything like that. It just, you look at what's the written terms. Hey, the written term says it's month to month, so I guess it's a short-term lease, that kind of thing, right? So CECL is the big one here. And basically what I want people to take away from CECL is this. Running out a little bit of time here, so I'm going to jump around a little bit. The biggest misconception is that it only impacts financial services, right? That's not the case. It will have an impact on practically every business because it will have an impact on trade AR. And it will likely require an increase in AR allowance, right? What the old model said is you had to wait until you incurred a loss. So until something was overdue or you had some reason to believe. Now this says you have to expect what those credit losses are. So that means you can have a current receivable that is not past due, but you need to record an allowance for. And of course, the question I get from a lot of folks is, well, what if my history says that I've never had any significant losses? So I guess I'll just, put a 0 next to this allowance. That's probably not going to fly. There's an example in there in the Big Four guidance. Basically, if you read them all, what it basically is saying is even really high rated bonds have a certain amount of failure rate. And really the only, entity that can really guarantee to give you the money is a entity that can print money, the government, right? And so generally, I'm going to say you're more likely going to have an increase in AR allowance if you did not have a general reserve that applied to all receivables, even those that were current. So that's going to be the biggest change. Keep a lookout for that. Question number 4, does this only apply to financial institutions? And is it not expected to change current practice for most entities?
Let's see who was paying attention this time, right, Michael?
Mm-hmm. So.
And I think after this one, I know we are coming close to the time mark, but we still have a little bit to cover. So for those folks who do have to jump, I'm going to go ahead and launch the 5th poll question right after the 4th one, just in case you do have to leave us at 2 o'clock Eastern.
Yep.
Okay, I'm going to give a few more seconds here for the poll. All right.
False. Yes. All right. People are definitely paying attention. Yes. So it does not apply just to financial institutions, and it is expected to have a change even for most entities. So keep a lookout for that. So I'm going to go ahead and jump in then to some of the independence ones. These aren't going to take a lot of time to go through. There's a number of independence changes that occurred. The 2 that I want to talk about that I think are going to be most impactful are the 2 in red here. And the first one is information system services. What this basically says is that when you have an auditor that helps you implement a new accounting system, right? There are certain things that they are now not allowed to do. And if they do, they're going to violate independence, and things that they still are allowed to do. And basically the concept is that auditors are never going to be allowed to design the code or to elect the configurations, right? They can do simple things and they can check to make sure that information carried over correctly, but they cannot be the ones designing your information system, essentially, right? So I'm not going to go over each of these items for the sake of time, and because they're pretty well written out here in the slide. But just be aware that if you have your auditor helping you out with information system adjustments or transitioning, that they are aware of, because some might not be, and that you're aware of, there are certain restrictions now. And that's important because, unfortunately, if independence is binary, if they do these procedures and they're in violation of independence, that's a failed audit. And so that's something that you, both the auditor and you, are not going to want to deal with. And that's effective as of the beginning of this year. And so if you had it done prior to 12/31, you're good. If you have an information systems change happening, you have your auditors working on it on a go-forward basis this year and going forward, just be cognizant of that. The other thing is assistance with implementing accounting standards. This is the last one here. And this basically is that there was a little bit of consternation and question about, well, can your auditor help you with implementing a new accounting standard? And basically the overall concept is, as long as they're not performing management responsibilities and as long as management accepts responsibility, so the first two bullet points here, then you're probably okay. There are certain things you can't do, like the auditor can't lead or supervise the implementation effort or make decisions or set policy or accept responsibility. At the end of the day, they have to be there to assist management. And so there are things that they can do, like providing training, doing research to assist management. They can provide advice and recommendations, but again, they can't be the ones making the actual decision. They can even propose journal entries, right? As long as management reviews and understands those journal entries. And there's the fifth polling question, which I think most everyone's already answered now. And with that, I want to thank everyone. Sorry for going a couple minutes over, but thank you, everyone. If you have any kind of questions or there's some things in the chat, we'll try to get with and email people individually. But if you have questions, you can email me directly.
All right. Thank you so much, Michael. Just a reminder to you folks, thank you for staying with us a couple extra minutes. You will be directed to a survey right after the session. We're constantly looking for ways to improve. So go ahead, give Michael some applause or different reactions right now, and fill out that survey as soon as the session concludes. Thanks so much.
Thank you.